What is a convertible note in angel investing? Have you ever wondered how startups get the funding they need to grow? One popular method is through something called a convertible note. So, what exactly is a convertible note in angel investing? Let's break it down in simple terms. A convertible note is a financial tool used by angel investors to provide early-stage funding to startups. Think of it as a short-term loan that an investor gives to a startup. The exciting part is that this loan can later convert into ownership shares of the company. At first, a convertible note acts like a regular loan. The investor gives money to the startup, and the startup promises to pay it back, often with some interest, until a specific date known as the maturity date. This maturity date usually falls within 18 to 24 months after the investment. Now, here's where it gets interesting. Instead of paying back the loan in cash, the startup can convert the note into shares of the company's stock during a future funding round. This typically happens when the startup raises money from venture capitalists or other investors. To protect early investors, convertible notes often include a valuation cap. This cap sets a maximum company valuation at which the note can convert into equity. This means that even if the startup's value skyrockets, early investors can convert at a more favorable price. Another feature is the conversion discount. This discount allows investors to buy shares at a lower price when the note converts. Discounts usually range from 10% to 30%, rewarding those who took the risk of investing early. Convertible notes also accrue interest, similar to traditional loans. However, most investors focus on the potential for equity rather than interest payments. What happens if the startup is sold or liquidated before the note converts? Convertible notes often have provisions that allow investors to recover their investment plus a premium or convert into equity at a set valuation. This gives investors some protection in case things do not go as planned. For banks and credit unions, convertible notes representing a unique financing option that balances risk and reward. Unlike standard loans, which requiring regular payments and collateral, convertible notes defer repayment and offer potential equity upside. This structure is particularly appealing for early-stage startups, where traditional loans may not be an option. Convertible notes allow startups to raise capital quickly without needing a formal valuation, which can be tricky in the early stages. For angel investors, convertible notes provide a way to participate in a startup's growth while having some downside protection typical of debt instruments. In essence, a convertible note is a loan that can transform into equity at a future financing event, featuring terms like maturity dates, valuation caps, and conversion discounts. This financial instrument bridges the gap between debt and equity, offering flexibility and risk management for early-stage investments. Understanding convertible notes is essential for anyone interested in angel investing or looking to explore investment strategies in personal finance.